Hi, I'm Sarvesh. And in last video, we have discussed on why should you invest and the inflations and the need to invest. And in this video, we'll discuss on where can you invest. You could invest on fixed income instruments, real estate, commodities, and stock market. I would discuss each in detail. Fixed income instruments consist of bank FDs and some debt instruments. Bank FDs are where you could deposit your money in bank and in return they give you around 4 to 7% annual returns. And debt instruments consists of bond where you could lend your money to government or some corporate organizations for their requirements, and in return they return you around 5 to 10% per annum fixed returns. And in if you see in FDs the risk is zero, almost zero, and in bonds the risk is bare minimum. And in this rate, in this in returns, you could in FDs, I think you can't even beat the inflation around 7.14%. And in bonds, you could just beat the inflation rate. Next, if we discuss on real estates, there are land sites, apartments, houses, and some commercial buildings where you could invest your money. And the advantage of this is you could have two sources of income. Could have rental income as well as capital appreciation. Each year, the value of your prices keeps rising, and you could even charge some rental income for your property. But some disadvantages are that cash outlay is large. You require some high capital for buying land or some properties, and liquidity is also very less. You can't buy or sell whenever you need, and you have to find a proper buyer or seller for some transactions, and you can't get that proper deal at the price you want. You have to negotiate it, and there are some things like that. And transaction procedure is also not so simple. Like each time you have to have document verification, the process is quite complex, and returns can't be predicted as there is no proper fixed metrics to predict. Next, we will come as to commodities. Commodities are something like a raw material. It can be gold, silver, oil, some grains, or copper, or anything like that, metals. And if we see generally, we know that gold prices are keeps on increasing, and the trend is like for even more than a century, the prices keeps on increasing. And if we see the average return is around 9% in the past 10 years, and risk we could say it's quite safe investment and risk is less. And even in this, you could just beat the inflation, and they could have a 9% is just beating inflation. And next is stock market. In stock, there is a called as equities market where you could buy shares of companies. And there are two exchanges called as National Stock Exchange and Bombay Stock Exchange, NSE and BSE, from where you could buy the stocks of listed companies, shares of listed companies. And investments in this has given a general return of around 14 to 15% per annum, comparing with it with respect to the indexes of Nifty and Sensex. I would explain detail about these indexes in another video of this course. And if we see risk is quite higher in the stock market compared to other investments, as there is potential of you to even lose your complete capital in these investments. But even you could have make more than 100% return also. Everything is possible. And now let me explain like return on investments for long term. Let us take for 1 lakh invested in 20 years in three instruments: fixed income, gold, and equities. I have taken an average of 7% for fixed income, 9 for gold, and 14 for equities. And 1 lakh has been converted into 3 lakh 86,000 in fixed income. And in gold, if you see, it is converted into 5 lakh 60,000. And in equities, it's converted to around 13 lakh 74,000. You see, return on investment for fixed income, it's around 286%. And for gold, it's around 460%. And for equities, around 1274%. You could see in long term, for each percent increase in CAGR, in long term, the effect will be big. You could see the difference in return on investment after 20 years. In 1 year, it's actually 1 or 2%, but in long term, the difference will be huge due to compounding effect.